Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nraja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In this session, I'll take you through the difference between DSCR and FOIR. First, let's look at the meaning. What do we mean by DSCR? When we say DSCR, it stands for Debt Service Coverage Ratio. Here, banks and financial institutions are basically going to measure the repayment capacity of the borrower for the term loan they have availed for a project. So what is the focus? The focus is measuring repayment capacity of the borrower. Then what is FOIR? FOIR stands for Fixed Obligation Income Ratio. And here also bank is going to measure the repayment capacity. But here it is measuring the repayment capacity of the borrower with reference to it can be a business loan, a mortgage loan, or a long-term loan. But both the ratios, they basically measure repayment capacity. Okay, what is the formula that is used in these ratios? First, let's look at DSCR. DSCR ratio, the formula, numerator is cash accruals and denominator is obligation. How this cash accruals is calculated? It is calculated as profit after tax. Then it is added back by depreciation because it is a non-cash item. Then it is added back by interest on term loan because we want to know what is the cash profit before paying interest. So for that reason, we add back interest on term loan. This goes to the numerator. Whereas in the denominator, it will be interest on term loan plus principal commitment. So this will be calculated for each and every year so that DSCR of each and every year can be understood and arrived at. Whereas FOIR, the formula is like this. It is fixed obligation divided by income. And when I say fixed obligation, it is the fixed obligation with regard to the present loans which are running and the future loans that is proposed. Okay, so this fixed obligation is basically the summation of EMI, which includes interest and principal. So you should factor both the present running outstanding loans commitments as well as the proposed loan commitments. That goes to the numerator. Whereas in the denominator, it is income. When we say income, this is cash profit. And this is one distinct difference when compared with DSCR. Here, when we take the income in FOIR, that is the cash profit, it is freezed as per last financial information. That is, if the customer is approaching now, let's say we are in December 20, the customer is approaching loan now for let's say next 5 years. For next 5 years, what will be his cash profit? That will be based on his last submitted financials. In next 5 years, he may earn more, he may have more cash profit, but that will not be taken into consideration. Okay, so that's the distinct point when it comes to FOIR, because in DSCR, what you are going to do is you are going to arrive at cash profit for future, and in future this cash profit can be estimated to increase. That's what I have in next point. Look at here how cash source is measured. If you take DSCR, it factors estimated projected cash flows which can be based on future cash profits, and this future cash profit can be estimated to increase. Let's say, for example, a customer approaching a bank for a term loan to start a business. It means this business will acquire assets. Using that asset, they will produce product, then they will make sale, then out of that they will make profit, and using that profit they will service the loan. Okay, in those cases DSCR will work out. Even for existing businesses which are going for expansion, it's possible that their cash profit can increase from their present level. In those cases, also DSCR will work out. But wherever this FOIR ratio is used, it is always based on cash profit asset last year. It will be pegged at that level. Let's say, for example, the cash profit of the last year is 1 crore and they have come for a term loan, let's say repayable over a period of 5 years. A term loan, let's say like a mortgage loan. Now, for the next 5 years, their annual cash profit will be freezed at 1 crore. So with that 1 crore, whether they will be able to service the loan or not, that's what getting measured. Whereas in DSCR, it is possible that this 1 crore can increase because of change in sale, because of change in capacity, because of change in fixed assets. So that element will be accepted in DSCR, but not in FOIR. Okay. So this is how cash source is measured. Then what are the obligations that are considered? Because in both the ratios, what we are doing, we are comparing the income and obligation. Okay, what obligation? I think here both DSCR and FOIR does the same job. DSCR factors running past loan obligations as well as the proposed loan obligation. FOIR also factors running past loan as well as the proposed loan obligations. Okay. When DSCR is suitable, when FOIR is suitable. DSCR is suitable for project financing, let's say like term loan, because this is going to involve estimation, projection. It's possible future revenue can be estimated, projected to increase, same the profits and cash profits. Whereas FOIR can be used for medium to long term loans where the repayment is based on existing cash profit, existing capacity. That's why generally we see this in mortgage loan, business loans and all, right? And what is the minimum acceptable level? If you take DSCR, the minimum acceptable DSCR for each and every year throughout the loan tenor will be like 1.5 times every year. Of course, it could vary bank to bank depending upon the bank's risk perception. Conservative bank will say something like 1.5 times, whereas the banks which are ready to take a little bit of risk, they'll go even up to 1 time. Okay, this is every year. That is, if the loan is for 5 years, for each and every year, the ratio should be at least 1.5. And average DSCR will also be calculated, which should be at least 1.75. And again, it can vary bank to bank. That's about DSCR. Whereas FOIR, it is calculated in a kind of a reverse model because we are comparing the fixed obligation with the income. Okay, so fixed obligation is seen as a proportion of income. So it should be between 40 to 55%. So if fixed obligations are greater than 55%, it means they are leveraged. They may not become eligible for financing. But on the other side, if FOIR is below, much below, say somewhere like below 40%, it indicates they have much of repayment capacity. Okay, so these are the broader differences. Even other differences can be added, but these are all the differences which I wish to add. Thank you so much. We have come to the end of this webinar and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking Credit Courses Bundle. This includes course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far, I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.